Welcome to this session, dear students. In this session, we shall talk about income from salary. Income from salary is the income or remuneration received by an individual for services he is rendering or a contract undertaken by him. This clause essentially assimilates the remuneration received by a person for the services provided by him under the employer-employee relationship. Any payment that is received by a person will be treated as income under this Income Tax Act if one has employer-employee relationship. The salary for the purpose of calculation would consist of wages, pension, annuity, gratuity, advanced salary paid, fees, etc. So, if one wants to look at classification of various income under the charging section, then dear students, salary charging section is section 15 of the Income Tax Act 1961. Income from house property charging section is 22. Profit and gains from business and profession is 28. Capital gains are under 45 and income from other sources are 56. And we have respective deductions available for the heads of income. For salary income, deductions are available under section 16. One must have heard the term CTC. CTC generally stands for cost to company. It may be noted that CTC varies from the actual income from salary that a person receives, as CTC also includes variable and fixed pay. So, salaries under section 17(1) includes the following, that is wages, annuity, gratuity, fees, provident fund and the contribution made by the government in the previous year under a pension scheme. So, section 617 has 3 subsections which are totally calculated as salary under section 17 subsection 1, perquisite under section 17 subsection 2 and profit in lieu of salary under section 17 of subsection 3. So, these allowances are divided into 3 aspects, namely fully taxable, partially taxable and fully exempt. So, fully taxable allowance are like entertainment allowance, dearness allowance, etc. Entertainment allowance, this is an allowance that is provided to an employee to reimburse the expenses which are incurred on account of hospitality for the corporate clients. Dearness allowance is the allowance paid to employee to cope with the inflation. Wartime allowance is the allowance which is paid to the employee for working above the regular hours. City compensatory allowance is paid to those employees who move to urban cities. Similarly, tiffin allowance is for the meal allowances. Partially taxable allowance are, for example, HRA, etc. HRA, that is house rent allowance, it is the allowance that an employer pays to his employee for accommodation. Special allowances like travel, uniform, research allowances are also paid. Some special allowances are paid to meet personal expenses like children's education allowance, children hostel allowance, etc. Fully exempt allowances, we can also call as non-taxable allowances, are allowances that is paid to High Court judges or United Nations organization employees or judges of other courts or granted to employees outside India. When the government employee of India are paid allowances, these come under fully exempt allowances. Usually this happens when they serve outside India. And dear students, if you observed, I had also mentioned about perquisites. Perquisites are those payments which are received by an employee from the employer over and above the salary. Perquisites that are taxable for all the employees are rent-free accommodation, club fee payments, movable assets, concession in accommodation or rent, rent-free loan, etc. Perquisites that are taxable only to specified employees are free gas payments, electricity, concessional education expenses, etc. Perquisites that are exempt from tax are medical benefits, health insurance premium, LTC, staff welfare scheme, car or laptop used for personal use, etc. Profit in lieu of salary is any amount of compensation received by an employee from his employer or former employer in connection with the termination of employment or modification of terms and conditions of employment is regarded as profit in lieu of salary. So, dear students, under section 17, any amount received is taxable under salary, and after calculation of salary, the assessee is required to apply the required deductions and calculate the total tax payable. As and when the salary is paid, the employer is required to deduct TDS, that is tax deducted at source, and remit the same to government. The TDS such deducted will be visible under 26 AS, and as the assessee is getting his TDS deducted, the employer issues Form 16 to the employee at the end of the year, which comprises of the details of the gross total income received by the employee from the salary and any deductions which has been incorporated to arrive at the tax payable. So, this is the format of the Form 16, which is issued once a year. After the receipt of Form 16, the employee is required to file his income tax return before the due date. This is for the session, my dear students. I am Padmini Vasan. I shall see you soon in the next session. Thank you.